Hey folks, it's Dave Burrows at Barometer Capital Management. Thanks so much for everybody for joining us today. It is June the 3rd, so we're into summer. Market's been pretty good over the last few weeks. Coming off the lows in April, market's been rallying back. Some sectors obviously better than others. And as usual, what we'd like to do today is take a rundown from the top down, take a look at what we're seeing in market internals, looking at asset classes, strong ones versus weak ones, and then drilling down into some individual positioning. As always, we like to do this because it keeps us honest. We put up pictures and pictures tell 1,000 words. So look, I think this is always an interesting exercise, and certainly we'd be happy to take questions afterwards. I've asked Brian McNichol to join us today. He's one of our core portfolio managers. He focuses on Canadian equities. We're going to talk a little bit about financials today on the way through as an important group. And so let's get going. So just off the top, we consider that we are in a long-term structural bull market in equities globally. It was kicked off in 2013 in US equities. And like every one of these dark blue periods, they tend to go on a long time. We're about 12 years in. These things can last anywhere sort of 15 to 18 years. And there's really no sign that this is over. We recently corrected on the news of the tariffs down to the rising 200-week moving average, which you can see tends to lower bound a bull market like it did in the 80s and 90s, and like it has since 2013. We get corrections in this type of market, but they are not like the ones we get in a secular bear market, which are much more significant. And you can make money in these runs back and forth. You got to be a little bit more tactical. So in a structural bull market, we tend to give the market a little bit more rope. Sometimes the news that we see on the front pages, is important, but there's other things in the background driving prices and driving flows. So we look at the near-term results for the S&P 500. We came right down to the trend line that's been in place since the low in October of 22. And the market has rallied in fits and starts. We are back above the 50-day moving average, which is now starting to tilt back higher. We're above the 8 and the 21-day moving average, and we're above the rising 200-day moving average. So that's an important measure of trend. It's important that it's starting to tilt back higher. We've yet to make a new high, so that remains to be seen. But the balance of evidence is that things have been getting better. Now, the S&P obviously driven by some very big companies. The impact of the top 7 or 8 stocks is obviously way bigger than anything sort of 200 companies and down. We look at the NASDAQ, also dominated by some very big companies. It also has climbed back above all of its moving averages, back above the trend line that was in place back to the 22 low, but also not yet back to making new highs. Now, when I look internally at the market, like the equal weight S&P, this gives us some information. The equally weighted S&P has not rallied back to the same extent. So what that means is some big companies have had a great rally back, and I understand that. Mega cap stocks have led for years. It would be a go-to for people who want to put money back in the market. And we know that a lot of the money that's come into the market in April and May was private investors. Institutions have been more hesitant. Institutional investors in general have not been putting money back to work in the same way. We also look at the Russell 2000. Now, this is smaller cap companies, but you can see still well below the 200-day moving average, and it's recouped somewhere between a third and a half of what it gave up in the 29% decline so far over the course of this year. So that to keep in mind. When we look at the breadth data across the major markets, the percent of stocks in uptrends in the US is slowly climbing. We're below the 50% level. So that means less than 1 in 2 stocks is in long-term uptrends. But breadth is expanding. That's important. Now, if I were to look under the surface, we have seen some pullback in some short-term measures over the last 2 weeks. Percent of stocks with positive weekly momentum or upward trajectory has slowed. The percent of stocks making new highs versus new lows has slowed and started to back up. And the percent of stocks trading above the 150-day moving average is down around 35%. So that's a good measure of trend. So it tells you that there's a subset in the market that are having a big impact on the indices that are doing better, but there's still a lot of stocks that are not participating to the same extent. If I were to break the US down, the S&P 500 bullish percent backed off a little bit this week. The bullish percent for the NASDAQ 100 backed off a little this week. The bullish percent for the mid-cap index pulled back a little this week. So we still have some caution. We think that there still is bumpy news flow, and we're now in the beginning of June and into July can be sloppy times of the year. That being said, there's some very clear themes. The Canadian market has been very strong, and bullish percent is ticking higher steadily. We're sitting about the recent highs. And world bullish percent, take all stocks globally, that's been stronger than anything. And that takes into account all these global markets. And you can see in green, if we put all of them on a distribution curve based on the percentage of stocks in each of the local markets that are in uptrends, you can see Europe, Japan, London, Israel, all sort of above 65%. And so it is something that we're seeing stronger global stocks. Now, part of that has to do with the fact that the US dollar versus the world currencies, has continued to weaken. There's a lot of people who are quite concerned about this because, of course, the US dollar is the reserve currency. But clearly, since early this year, US dollar started to back off from what was quite an overbought condition, but has steadily moved lower, and you can see all the moving averages moving lower. We recently broke this support and we bounced up underneath it, but this is clearly in a downtrend. And some of the technical indicators would highlight that any bounce here might be a bounce in a downtrend. So that has implications for assets outside the US. This implies that global investors are taking money from US dollars, which they've held for a long time because it was a safe place to be, and because the US market was the only market generating returns, and they're repatriating to local markets. So if we look at the SPDW, which is an ETF made up of developed market equities outside the US, you can see it traded in a range from 2008 to 2024. And this month was the month of May, and we're now into the month of June, and we're breaking out. So there's obviously stronger markets and weaker markets. But Europe as a whole looks very strong and has been for quite some number of months. Germany is a great example, but we could look at Italy, we could look at Spain, we can look at all kinds of European markets and they all look good. The Swiss market looks tremendous. We go to Latin America. Argentina's been strong now for 2 years. And in behind it, we've got Peru breaking out. And Chile also is acting well. These are markets that tend to have a pretty good exposure to inflation-oriented assets. So Europe, heavily dominated by financial services and industrials. Latin America, heavily dominated by energy and resources, also financial services. There's a bunch of markets that look really darn good. This is the Japanese market, the EWJ ETF. This is unhedged for currency. And so you can see it's breaking out in US dollar terms. And if we look under the surface at the smaller cap stocks, the JOF is a representative of the Topix 1500. It's up 24% year to date. So global stocks really are an alternative. Global currencies are an alternative. And the Canadian market's an alternative. Funny given the concern around tariffs, but when you think about it, a lot of these markets are not driven by the consumer. They're driven by, sectors in some cases not so impacted by tariffs. And so remember, it's a market of stocks. You're not looking at the overall international economies. So TSX versus the equally weighted S&P, very clear shift. over the last couple of years. And that's one that probably is relatively early stage. The MSCI All World Index, after years of underperformance, MSCI All World relative to the equally weighted S&P, underperforming, outperforming. That's a shift. It's a secular shift. So early days. So we really continue to drive client portfolios to just bit by bit add global exposure as this theme becomes more and more clear. And all of the major currencies are rallying versus US dollar, and certainly the Canadian dollar is not an exception. We came down to the lows we've seen in both of the most recent climactic lows, and that happened around the time the tariffs got announced, and we've been working our way higher since. Other assets that do well in the face of a weak US dollar. Well, here's Bitcoin. So Bitcoin versus US dollars. So I would say in general, we're wanting to look at assets that benefit from a weak US dollar and flows that benefit from a weak US dollar. And all of the things that you would expect are performing well, which tells that the market thinks this is something that's sustainable. Now, moving on to fixed income, obviously rates have been moving higher since 2020. This was a generational low. And despite, all of the bully pulpit talk from the White House about getting costs under control, the bond market doesn't believe it. So I think that this is important because companies that require financing are having a higher cost of capital. It means that if you're a borrower, it's getting more difficult and your valuation is likely lower. On the other hand, if you're a cash generator or you're a company that has an ability to raise price, that helps you to offset some of these factors. So, when I look at long-term treasury bonds, this is something that does not benefit in this environment. And there's a lot of treasury bonds coming up for renewal this year. And internally, it's difficult to match up what the US administration is doing with what they're saying. Even Elon Musk, who was very, very supportive of Donald Trump going through the election, came out today and said, "I'm sorry, I just can't stand it anymore. This massive, outrageous, pork-filled congressional spending bill, it is a disgusting abomination." So the bond market's telling us something. The bond market is becoming the enforcer. It's saying there's too much debt. You're going to have to compensate us more for taking the risk to give you money for 30 years because we don't know what currency we're going to get back. So as investors, we have to make decisions. Where do we put our money? And now for, over the last 4 years, really with some brief periods of respite, we've had a view that stocks were the preferred place to build portfolios. Stocks versus bonds, basically back to making new highs. Moving on to commodities, commodity prices marching month by month higher, some better, some worse, but probably the poster child is gold. Now, after 7 weeks of consolidation, gold is trying to break out again to the upside. It's been able to stay above all of the long and short-term moving averages. And as we talked about, there are going to be check stops along the way, but likely we have a number of legs of this rally. So seasonally, we could see this chop sideways. It's not acting like it wants to. I'm surprised by that. But frankly, I understand why. There's significant debt at the sovereign level in every major country around the world. And we're now seeing gold supported by a move up in silver, which tends to move in the second leg of the gold move. And so that's something to consider. So going back to asset choices, gold relative to QQQ, gold net relative to technology, we think has been going through a shift over the last couple of years. And we corrected a little bit over the last 2 months, but my guess is gold continues to outperform. Gold versus semis, same picture, corrected over the last 2 months, but my guess is it likely resumes. So we did add some gold back to the portfolios over the last week. We maintained a position through the little bit of a correction. And as it strengthens, we'll look to add to our positions. Also in commodities, so copper is firming up, and what we think about an asset that moves outside of a range it's been into for years. We're watching this with interest. And if we look at commodities relative to bonds or inflation assets relative to a disinflationary asset, well, it's hard to argue. It continues to be inflationary assets are the preferred asset. Stocks versus bonds, commodities relative to equal weight S&P, commodities and equities, I think, are the two places we want to focus. And Bitcoin as a diversifier is something that we hold in our macro portfolio. So look, we don't have to be anywhere. Our job is to find leadership, areas of the market that have a tailwind. Focus our attention in those areas, watch for change, new leadership to emerge, old leadership to recede, and be prepared to adjust the portfolios along the way. Sometimes when breadth is weak, our job is to play some defense. And we've got to manage the mix in the portfolio to make sure it lines up with the climate that we're in. And it's really important not to get caught up in the headlines. So without spending too much time on it, as you know, we focus on trying to find parts of the market that are seeing net inflows. And then we try to find securities that meet our fundamental and technical tests. We're looking for parts of the market that are seeing expanding breadth. And we're trying to avoid areas where breadth is deteriorating. So ultimately, it's about making sure we carve out the stuff that stops working and maintain the stuff that holds on to strength, and you stop losses to do it. Okay, let's talk leadership, because it's really important. Where are we targeting? Where is money getting put to work? What held up better through the decline? What rallied better on the other side? And the first place I have to start is financials, and this has been leadership for a long time. This is the XLF ETF. We're trading basically at highs. These are monthly bars. You can see it went down sharply in the beginning of the month of April and closed right back at the highs, was higher in the month of May and now higher again in the month of June. Leading stocks within the group, JPMorgan continues to outperform all of the major US banks. We added Morgan Stanley. As it started to recover, you can see relative strength really has been rising since last August. And then we get to the Canadian banks. So we've been through the reporting period. I have a mea culpa. I had Brian McNichol on the call last week and completely forgot that he was there. So I owe him a big apology, and he's joined us this week. Brian, come on, let's talk a little bit about Canadian bank earnings, what we were looking for, what we got, who won, who lost. Give us the box scores.
Perfect. Thanks, Dave. So Canadian banks, they wrapped up earnings late last week. And for the most part, the quarter itself was better than expectations across the board. So I would really call most of the banks, maybe with the exception of Scotiabank, that was a little bit weaker than expected, as the key winners. So going into the quarter, the main point of interest for us was really around the overall health of credit for each individual bank. We were expecting management teams to take a pretty conservative approach to their credit provisioning, by increasing provisions at a faster rate in order to help build a buffer against any impact that tariffs may have on the overall consumer and on commercial lines. And it's pretty much exactly what we saw, although they weren't as severe as where expectations were, as the provisions built on impaired loans were better than expected for all banks. So really a solid thing to see. Provisions, they act as an offset to the bottom line. So as a result, earnings were much, much stronger than expected for the majority of the banks. Overall, the loan growth environment is not really getting any better for the space. We saw a continued moderation of lending volumes, notably across mortgage and commercial portfolios, and that's on the back of stifled credit demand. So this is definitely an important metric to watch in the quarters to come. This quarter, the main driver of growth once again came from the capital markets business. It's not a big shock for us. Trading revenues are going to continue to benefit from the increased volatility in the market. And it's a very similar theme behind our rationale of our investment within TMX Group and CME Group in the US as well. Capital levels for all the banks were very solid. Each bank remains extremely well capitalized and should be supportive of healthy buyback activity in the second half of the year. And that'll be led by TD, as they're going to look to return capital shareholders following the sale of Charles Schwab and their inability to acquire in the US for the time being. So we will get a better picture on their investor day. I believe it's in September, on their overall makeup of their share buyback program, but expect it to be very substantial. So our exposure levels going into the print, they were minimal relative to TSX weightings. We only had exposure to BMO and Royal. We really like Royal for their diversification between business lines and then increased exposure to trading revenues relative to the rest of the banks. Roughly 30% of revenue comes from trading. And BMO, we just believe that their prior credit issues are really in the rearview mirror, and we saw a chance to add the stock at a lower valuation than it generally trades at. So both banks, really solid results in our opinion. Royal was the only bank of the big six that actually sold off following their print, as management took a more conservative approach to credit. They built up provisions, greater than what was expected, which, as I mentioned, does impact the bottom line. So they posted a slight earnings miss. But removing the impact of credit, they probably had the best fundamental quarter of the group. They were able to manage expenses very well. So overall operating leverage was very positive. And we saw some really strong pre-tax, pre-provision, so ex-credit earnings growth, both in Canada and the US for Royal. We liked how they've traded since reporting. They're now only about 1% off of previous highs. So we don't see an issue with this one at all going forward.
So Brian, I put you on the spot because, we've had these positions in the P&C insurance companies, and Intact just continues to chug along. Of course, Fairfax been so strong. What do you think is the biggest driving factor that we should be watching over the next year for this group?
Yeah, for this group, it continues to be a pretty tight market with respect to premiums.
And when you say tight market, you mean their pricing power is pretty strong?
Yes. Sorry. Yes. Yeah. Great pricing power for the insurers. We saw an oversized experience of cat losses, so catastrophe losses, in the prior year, and as a result, premiums are going up across the board. So they should continue to benefit from that. And then on top of that, they have their own investment platform underneath it that continues to perform well, and that's been a really good driver for a name like Fairfax. Intact as well is also benefiting from that as well.
I'll tell you, I hate seeing my premiums come in every year, but I like being a shareholder to offset them.
Yeah, exactly.
Well, whether it's the banks or whether it's the insurance companies or the exchanges, this whole financials sector continues to perform well. It obviously is one that has limited impact from tariffs, but certainly they have a tailwind in a world where, the power is in the hands of the lender at this point. And even the card companies, trading right back to highs after pulling back to the long-term moving averages. So really pleased on the positions that we have in North America. And then, of course, the European financials have just been on fire, and very, very happy with the experience we had with Santander. We bought some Santander just as it pulled back, but look at the rally back. It made new highs in about 10 trading days and has been powering its way higher since then. So trading better now than 95% of companies in the S&P over the last 52 weeks. So, they've been performing well, but, in the scheme of things, on a very long-term picture, the Eurozone financials were in a range from 2009 through 2025. This is just a great breakout on the long-term chart, and one that probably supports in fits and starts these companies moving higher for several years. So really, really pleased with the exposure there. And it's been a big part of portfolios and having a real positive impact. The other group that's come back nicely is industrials. The XLI, which is the industrials ETF, capital weighted, pulled back the 200 right back to new highs. And I think actually I forgot to update this chart this week because we are making new highs. But internally, when we look at the group, the aerospace and defense companies, are just on fire. Relative strength has been working its way higher steadily. Clearly, governments around the world are committing more and more of their budget to satisfy defense spending. There's been a lot of pressure from the US for NATO countries to do that. Howmet Aerospace has been a big, big beneficiary of some delayed jet engine orders from GE. They sell replacement parts. But this has been a great position. I think we're in this one at about $40. It's 172. GE Aerospace on the jet engines, which are now getting close to coming online, and big spending on maintenance and repairs, is acting like a champ. And in the power space, GE Vernova, making gas turbine gas turbine blades, performing really, really, really well. So this whole group continues to perform well. And of course, with the industrial renaissance going on in the US, the engineering companies that are helping build plants and design plants and production facilities benefiting as well. So Stantec and WSP in this group are two good holdings that we think can make a difference as we go forward. So some big structural themes that aren't going away, whether there's tariffs or not, and in fact, may be accelerated. There's the European Defense Index. So you can see it's actually even stronger than the US Defense Index, and we own Embriar in Brazil. So energy is always a hot topic, here in our local market. This is the equally weighted Canadian Energy Producers Index. And this is one time where an index doesn't really do justice. On one side, we've got the oil producers, quite weak on a relative basis, and oil has been weak. But if we look at the gas producers, they continue to be strong both in Canada and the US. ARC Resources, continue to work its way higher. Expand Energy, to combination of the old Chesapeake and Southwest Energy, continuing to make new highs. And Cheniere on the liquefied natural gas infrastructure performing really well. The one thing that we're a little watchful of is some of the pipes. They aren't going down. They've been pretty stable. Relative strength has been a little weaker, but we are getting paid, pretty nice dividends. So we'll watch these a little bit closely. Moving on to materials. Let's talk about gold for a minute. So on the weekly chart, going back to 2020, this was the move higher that we've seen so far in the GDX, which is the Senior Gold Producers ETF. And we did break out and got a little extended above the moving averages and corrected over the last 7 weeks. Now, I was a bit conflicted here because on one hand extended, on the other hand had recently broken out to new highs. So as it turns out, it looks like this correction may be short-lived. We'll have to see. But the GDX, the senior producers, yesterday traded basically back to highs. And actually, probably more importantly, the junior producers, this is the GDXJ, made and held a new high. Now, the reason that's important is when you get into the second leg, or really the stronger leg of a bull market, the junior companies should perform better than the seniors. So we'll see. But after a little pullback, Agnico coming right back toward highs, trading better than 86% of companies in the S&P. Wheaton Precious Metals has gone on to make new highs. Kinross is basically back to highs. So I know that Brian is watching for some levels in gold itself, but I would say the equities, which tend to lead the metal in a true bull market, are telling us that we're likely going higher. So seasonally, while we tend to see some sloppiness in June and July, at this point, it's really not showing up. And we've got to let price be our guide. Every year is different. And if there are some big changes taking place in the currency markets, and if there are some big changes happening in the bond markets, it may well be that we need to look at this a little bit differently. We know that over the last year, a lot of the buying of gold was central banks, and that private clients and private investors are largely underinvested, and institutions even more so. I saw a survey recently of family offices and private foundations where they showed that energy and metals made up less than 2% of the average portfolio. And really, it's the best performing asset over the last 18 months. Moving on, communications group, XLC, relative strength's been sort of flat, so it's been in line with the market. We've been pretty concentrated here just in Netflix, which continues to see rising relative strength. It held in really, really well. Consumer discretionary, you've heard me say we have some concerns in general about the group, and relative strength has not been much to talk about. We're still quite a ways back from the highs. Home builders continue to be very, very weak. Cars continue to be very weak. But some of the more staples oriented companies that are consumer discretionary, like Darden, which is Olive Garden, Americans love to eat out, and Olive Garden's doing a really good job. Dollarama in Canada, the dollar store is acting well, especially here in Canada, and certainly Loblaws has been a great holding. So these are more defensive in general than some of the luxury goods, but certainly they've performed really, really well through this piece. Technology, a hot topic. Relative strength has basically been in consolidation going back to May of last year. We'll see whether it can accelerate up and out of this. Obviously, a bunch of people jump back into big cap tech after the reaction low in the beginning of in the middle of March. CrowdStrike is the one major position that we have. It's reporting tonight and may well have reported already. It's charging to new highs, better than 95% of stocks. Now, we call this the utility of the tech sector because, of course, everybody needs cybersecurity technology to protect their networks. And CrowdStrike certainly is a big leader here. And Microsoft, has gone back to make a new high. Last high made was in November, and the relative strength is picking up nicely. Now, within this group, a big question mark for a year now has been semiconductors. We talked about the fact back in the summer of last year that semis were extended way above the moving averages, and they had a tendency to correct back to the long-term moving averages. So we really avoided this group over the last year. Had a very significant 41% correction top to bottom. It's rallied back and trying to fight its way back through the 200-day. And in every sector, there's going to be a couple of companies that behave better than the rest. And in this case, it's NVIDIA, which we came out of last year, but we have re-entered over the last couple of days. Relative strength has turned higher. It's basically been sideways since May of last year, and we'll see whether it can get up and out and make a new high. If any of them are going to, it's going to be NVIDIA. So we're starting with a small position here, and we'll see where we go. Healthcare, sort of a nothing. Staples, a nothing. These are two defensive groups. REITs, relative strength, very poor. All of these are hurt by rising interest rates. So when we look at what it all adds up to, not a lot of change. Financials continue to be the biggest weight. Industrial, second biggest weight. Energy, which is largely natural gas and pipes, next biggest weight. Great dividend and dividend yields here. Technology, this will be up by about 3%. So we're about 7% technology. This did not get updated today. And materials will be up about 4%. So we're closer to 7% materials, which is about a 3 times S&P weight. The defensive sectors really continue not to register heavily in the portfolios. So things are slowly getting better. The news is slightly worse. The earnings picture was actually quite good. That being said, most of the earnings for the quarter were derived before the announcement of tariffs. So we're watching for hard data. One of the things we watch is credit spreads, how much bond investors are demanding to take corporate risk versus government risk, and it's coming down. And even as it moved higher into the tariffs, got nowhere near where we got to in difficulties in 2020 or 2016. And volatility, which spiked, is now back into this range that we talk about being typical for more bull market conditions. So look, all we can do is take things day by day and week by week, assess the information as it comes, have a process, a system, and a discipline for selling, and try and make sure that the portfolios line up with the world that we're living in. As it stands, until something changes, equities are a great place to be to hedge inflation, specifically dividend growth. Commodities are another great hedge, and fixed income, which tends to be a good hedge for disinflation, is underperforming, so no need for us to be there now. If things get more difficult, we'll get more defensive. So look, we take information as it comes, and we try to be transparent about this. We try to answer questions. And with that, if you got any questions, let's take a crack at them. Okay, what have we got? where are my questions? Here we go. Robert Marzetti, what do you think of EUAD? So EUAD is the ETF that is for the European financials. And I think certainly it looks great, and we would be a buyer. Robert, Brian mentioned CME and X both pulled back today. I didn't see that X had pulled back. CME pulled back a little. Brian, see anything on CME today?
Nothing stock specific, but TMX finished flat on the day. It was down a little bit more going into the close. Really, I mean, I think we just see that kind of as a little bit of a check back for most of the defensive positionings. CME, as of yesterday's close, was at highs, so that's not an overly surprising move given technology was the main driver today.
Yeah. I mean, that's certainly nothing changing trend, that's for sure.
Yeah.
Steven's asking about drones, Brian. All we hear from Ukraine is how the war is evolving and drones are revolutionizing how the wars are being fought. Do we own any drone makers? And has that ship sailed? You know, it's interesting. A lot of the drone makers are small startups, and it's not particularly high technology, unless you're talking about, you know, drones that are like swarms of bees, and I think that some of that stuff comes out of companies like General Dynamics and would be a relatively small part. Teresa is asking, I don't think we mentioned uranium stocks thoughts. So we own a little bit of Cameco. I have a little bit of the nuclear ETF, NLR, in the macro portfolio. And also in materials, we did add some Nutrien, which seems to be shaping up. Certainly not from the same group, but in the materials. So yeah, I mean, the uranium companies are looking interesting. The nuclear companies themselves, nuclear power companies themselves, look interesting. And so, for instance, you know, GE will be a seller into that space for turbines. So Jerry's saying CrowdStrike pulled back after hours. Time to buy more. Well, we got to hear the conference call. So, you know, often on an initial announcement, stuff moves around a bunch, and then we get an opportunity to hear what management has to say. So after hours trading can be very misleading, especially right after earnings are announced. So we'll take a look, and I'm sure we'll have something to talk about next week. With that, I think we got all the questions. We appreciate everybody tuning in. I know you got lots of choices of things to do with your afternoon, and it's starting to get nice out there. So thanks for joining us. If we've got stuff we didn't answer, reach out. We're happy to jump on the phone. If you've got portfolio questions, please give us a call. We're all here and available. Brian, thanks very much for joining. And
Of course, happy to be here.
See everybody next week.